Hey everyone, Douglas here, Kenner Market Analysis, and yeah, I am in Washington, D.C. right now, nation's capital. Some other business brought me this way, and I thought what a better place to do an update than in front of none other than the Federal Reserve Building, the Eccles Building. And yeah, so to kind of make it timely, we'll talk some monetary policy and some other things, but as I'm recording this, it is about 7:30 on Wednesday, June 26th, and yeah, real quick, during the last update, I know I'd promised that we'd be getting a tutorial put out soon, Elliott Wave tutorial, and after kind of getting my my rough draft done and everything, I decided I wanted to kind of beef it up a little bit. So give me a few more weeks to get that out. I definitely still want to put that out, but I want to make sure it's something worthwhile putting out. So I'm going to put a little more effort in that. So that'll be out soon. Let's talk markets real quick too. The S&P continues to surge higher. The last couple of days we've had a bit of a pull off as we approached we made new all-time highs, and we've paused a little bit. But yeah, I mean from my vantage point, how I view markets, it's very much what's expected, and I definitely think in the not too distant future we will see a big breakthrough above 3,000. If you sign up for my Patreon. On my Patreon page and watch the last couple weeks of the macro updates, you'll definitely understand the case that's being made for why I think that, and I think it still remains quite valid for the time being. Another thing that's really been popping too, and I went long a week or two ago, was gold, and I kind of made the case for why I thought gold, or at least the environment, was positive for gold. Actually, at the beginning of the year on my TradingView page, which you can access if you search for Kenner Market Analysis over on TradingView, you'll run into my page, and I had an update there. But kind of will tie into a little bit what we're going to say in just a second about rate policy and that sort of thing. But gold does very well in environments where interest rates are plunging, and yet there's still kind of relatively growth-like environment, particularly where fiscal flows are strong, particularly where banking flows are strong, and we're seeing that. So we're seeing what would be kind of constituted as inflationary pressures with dropping interest rates, and that creates an environment where gold looks very very appealing to investors. So yeah, gold's been doing very nice, and I think that whole thing could reverse if interest rates go the opposite way, and then gold will start pushing down. And obviously we've got a lot of support from a dropping dollar here. So yeah, so a good little opportunity here for gold to make a run for it. And yeah, to tie in that, or kind of talk a little bit more about the interest rate piece, since we are in front of the Federal Reserve Building. Yeah, I thought it would be kind of timely to talk about is a week or two ago now, the Federal Reserve met right behind me, and decided that they would not not lower interest rates, but it definitely looks like they are prepping the market for exactly that they will bring interest rates down. And I think probably the way to put it is I really disagree with how the Federal Reserve sees interest rates as a mechanism for kind of controlling the economy. Yeah, probably the best way to put it is at best, moving the interest rate is completely ineffective, and at worst, it's actually the complete opposite. All the analysis I've done, all the data that I've studied, and again, I've put this in many updates over on the Patreon page in the past. But I'm fairly convinced that actually rising interest rates, pushing interest rates up is actually inflationary, and bringing interest rates down are deflationary. And again, I mean, I found some really good, strong correlated data for this, but just kind of two intuitive reasons for this would be, the first one is, just imagine if you had an 18-month project, some building you were building, it was going to take you 18 months, and interest rates were at 0%. Well, you know that all the purchases you have to make going over the next 18 months, and assuming whatever analysis you have says that interest rates will stay at that rate, that your costs are going to be flat over that amount of time, and that whatever anything costs you today, your borrowing costs and anything else that goes into that will be flat. Now let's say all of a sudden the interest rate pops to 10 or 20%, whatever it would be, it doesn't matter, but it rises. You know that the cost of doing business 18 months from now and until 18 months, the borrowing costs and all that sort of stuff to get any short-term funding you might need is going to be higher, and you have to price that in to whatever you're doing. So in that way, in and of itself, rising interest rates are going to put upward pressure on prices. The other reason that I think interest rates, and actually there might even be more, but at least that we'll talk about now, the other reason that I think interest rates, higher interest rates are inflationary is they actually create what's called a new income channel for new income into the economy. And again, just imagine if the interest rate was at zero again. That means that any bonds or anything, any bills that are being held are not paying any new money into the economy. If you're getting that, you're just literally getting your money back at the end of the duration, and that's it. But if interest rates were to suddenly be pushed to 10, 20% again, kind of going far out there, that's new money that's going into the economy. And those coupon payments are new money that didn't exist prior. And that in and of itself is going to be moderately inflationary. So I think there are many other reasons too that rising interest rates would be inflationary. And if you actually just look at the data itself, all through the 70s and 80s during that kind of runaway inflation that we had in the U.S., interest rates were going up, and I actually think the interest rates rising perpetuated the inflation. And furthermore, we've now seen Japan have 30 years of lowered interest rates, and they've never seen any inflation out of that, and they are in rock bottom deflationary, disinflationary environment at all times. And same thing with the U.S. and now the same thing with Europe. Over the last decade, we've seen that exact outcome. So that's why I like to kind of say, at worst, the interest rate mechanism does very little for actual economic activity one way or another. At best, it has no impact, and at worst, it actually does the exact opposite. One of my kind of economic heroes, Warren Mosler, kind of calls it the steering wheel that the kid has in the back seat, the steering wheel toy that you might put on the car seat that the kid has in the back seat. They might think they're driving, but they're not. In fact, it's the fiscal side, the person in the front seat with that wheel that is actually doing the driving. And I kind of like that analogy that the interest rate mechanism is again really ineffective, if not to the exact opposite of the kind of the intended purpose of what at least mainstream policy would have you think. And that even goes too for kind of the anti-Keynesian, right? The sound money people, because they were all worried that low interest rates would spur a bunch of lending, and we'd get runaway inflation. And their worry too was that the flooding of the reserves in the banking system would also get lent out, and that would spur inflation. But again, it's an inversion of what reality actually is. Banks don't loan reserves. Banks actually create the loan. The loans create the deposits, as they say in the banking system. And if anything, reserves crowd out other lending. If you have to hold majority reserves, and we talked about this in my most recent update, macro update on Cannon Market or on the Patreon page, that reserves crowd out other assets on a bank's balance sheet. So when the Federal Reserve tries to lower interest rates, what they're going to do when they get to the kind of the bottom level, and especially as they want to lower the longer end of the curve, like the 30-year end of the curve, they're going to flood the banking system with reserves, and they do that by doing an asset swap. They take out the bonds and increase the reserves on a bank's balance sheet. Well, if they're going to increase the reserves, that means that's space that the loans can't happen. So that's why we never got runaway inflation. That's why massive amounts of reserves in the banking system is going to be deflationary, really, or kind of anti-growth. So anyway, I thought it'd be a timely update since I was out here in front of the Federal Reserve building itself, and explain a little monetary policy. And I will be back hopefully next week with another update, and then very soon with some sort of Elliott Wave tutorial that is going to be beneficial. So in the meantime, good trading, everyone, and we'll see you next time. Bye-bye.